If I haven't met you before, I am Laura Dohanes. I'm a CPA here trying to help you and empower you to really think outside the box and really go into thinking tax strategy from all perspectives. And I want to make sure that we give a warm welcome to Dana Samuelson. And if you guys don't know, I really wanted to have this conversation because gold is taking front seat right now in the investing. The markets for gold is really high. And I'll give you some facts. Why should you be interested in gold? Who's investing in gold and who is really upping their inventory of gold right now? Why should be watching for gold? Dana is the perfect person to bring us information. He's been in the industry for more than 40 years. He's the president of American Gold Exchange, and he's an expert witness for the FBI. And he can share insights on the current trends on gold, silver, precious metals. And really, we want to look into, what does the market look like? What are we looking at in gold? And we want to tie that in with some tax strategy, right? How can we use gold in our tax strategy and wealth building? So, Dana, welcome, welcome. If you want to say a few words about your experience in this market, and if you want to kind of walk us through what you have for us today, because we're all interested in gold.
Well, thank you, Laura. It's my pleasure to be here with you. So I am physical precious metals and vintage U.S. gold and European coin dealer and expert. I have been in these markets for 44 years. I literally got my start right out of college in 1980, working in a vault, counting, shipping, and weighing stuff. And I ended up getting a lucky break working for one of the biggest industry players in the 1980s, Jim Blanchard, the man who was responsible for the private relegalization of gold ownership in 1974. So I've been in the gold markets my entire professional career, and I've watched as the fundamentals that drive the gold price have changed over the years. There are different drivers. Usually we have one, maybe two in the market at the same time. And what I want to talk to you today about is the fact that there are 4 or 5 drivers in the market at the same time, at the same place right now, which is very unusual. And that's why gold is hitting all-time highs and why I think it has room to go higher still in price. So I've got a PowerPoint presentation that will lay this out for you. And whenever you're ready, I can start that.
Yeah, please. Thank you so much. So, welcome, Dana. I'm excited to hear what you have. The stats are really speaking for themselves right now in the gold market. So, yeah, you can share your screen. I think
See if I
you
can
are
do this.
able to. Yeah.
See if I can do this. My company is American Gold Exchange. We are a national physical precious metal mail order dealership out of Austin, Texas. We're consultative in nature. So if anyone is interested in buying or selling physical precious metals, we're a good alternative. We're very competitively priced and we are user friendly. We really try and help people because that ends up helping us. This is our company information. So what I think the most fundamental thing I can tell you is gold should be considered 2 things. One, an insurance policy for the rest of your financial position. If you have 6 to 8% of your assets in gold or gold and silver, precious metals, it's a good hedge against financial uncertainty or other things that might affect the markets. Gold is a good counterbalance to traditional paper assets. Number one, it's also a great way to save money outside of a depreciating dollar. So you should think of gold as a savings account in lieu of dollars in the bank that are going to continue to lose purchasing power due to inflation. In my presentation, I'm going to walk you through what's happened to the gold price over the last 20 years briefly, and then I'm going to talk about what's happened primarily in the last 6 years, because that's really where all these different factors that drive the gold price have come into play in the same place at the same time today. So I'll walk you through the chart and show you these things so you can see for yourself what has affected the gold price. So start with traditional paper assets, stocks. These are the 2 periods of time where the Dow fundamentally took a big hit because of, number one, the great financial crisis first, and then COVID. If you had been invested as a buy and hold investor in stocks in 8, it would have been 4 or 5 years before you got back to whole again once the big decline that came from the great financial crisis hit. And again, during COVID, when we had that big sell-off highlighted in yellow, that was a whole year's worth of lost opportunity just to get back to even. Conversely, this is a gold chart that shows what happened to gold during those two same periods of time. Gold tends to climb a wall of worry. And there was a lot to worry about during the great financial crisis and when COVID hit. And both of those times, gold acted as a perfect counterbalance to paper assets. And that's the insurance policy that I mentioned. Fundamentally, over the last 20 years, primarily, gold has been tracking our debt higher. This is a chart of US debt going back to 2000. You can see in 2002, we were at $5 trillion in debt in the US. It took us 200 years to get to 5 trillion. By 2004, we were at 7 trillion. By 2014, we were at 17 trillion. We had doubled our debt in 10 years. And guess what? In the last 10 years, we've done it again. We've doubled our debt from 17 trillion now to 35 trillion today, which begs the question, what's our debt going to be like in another 10 years? Will we be at $70 trillion in debt? It's anybody's guess. But politicians on both sides cannot control spending today, and they have not for years. And also, with higher interest rates and higher debt, the debt service now is almost $1 trillion in annual interest expense, which is more than our annual defense budget. So I said gold has been tracking our debt higher. Here's a 20-year gold chart that shows gold getting a little bit ahead of itself during the great financial crisis over the blue trend lines. And when the economy was good in 2017, 18, and 19, gold got a little under the trend line that it's been following. But now we're back in trend, and actually we're back a little over trend, and I'll explain why that is. So these are the fundamental other drivers that push the gold price. Number one, in the short term, gold is most often affected on a daily, monthly, weekly basis by its inverse correlation to the value of the dollar and treasury yields or the interest rates. So gold is priced around the world in dollars, but most of the buying activity for gold is not in the United States. It's in Europe and Asia. We don't really have a gold culture in the United States, primarily because we've never had war on our shores and we've never had our currency fail. So if you've lived in a country where most of the rest of the world has over decades or even generations or centuries, where your currency has failed or you've been invaded, gold is a good thing because it's true, portable, and transferable wealth. Now, here's the thing. It's priced in dollars, but it's bought in Europe and Asia. So when the dollar becomes stronger in price against other currencies, when the dollar gains value against other currencies, it makes gold more expensive where most of it is consumed, in Europe and in Asia. Conversely, when the dollar becomes weaker relative to the euro or the yuan, the yen, gold becomes less expensive in other currencies, enhancing demand. That's the inverse correlation to the dollar. And also, gold does not pay a dividend. It doesn't pay a yield. And there are some costs associated with owning gold, storage and insurance. So when yields are higher than inflation and you have a positive real rate of return, gold tends to not do as well in value relative to paper assets where you can get a yield, treasuries, for instance. But if the inflation rate is higher than what you can get in yields, then you get a negative real rate of return. This is when gold tends to thrive. So that's the inverse correlation between gold and yields. Gold is also a hedge against economic and geopolitical instability. And gold is also a hedge against inflation, which is really currency debasement. It's the loss of purchasing power of the currency that you have. And if you look at the gold chart, it's really not that gold is becoming that much more valuable. It's that the dollar or the euro or the yen are buying less and less every year relative to gold. So that's really the case for holding gold over a long time. as an insurance policy, it tends to hold its value over time. So this is a 6-year gold chart, and this is where most of the meat of my presentation will be, going through the different drivers that have pushed gold up over the last 6 years to new record highs. So if you remember on that 20-year chart, there was a period where gold was underperforming in 2017, 18, and 19. Well, it was in the spring of 2019 where that little yellow highlighted bar is, just under the 1375 point on the gold chart, where I saw gold go up $50 and the market was really quiet. I was like, what's going on? What's making gold come back up $50 from 1270 to about 13 and a quarter when there's really nothing driving it? And I looked at treasury yields. The 10-year treasury yield was falling at that point in time. Here's a chart of the federal funds rate in black and the 10-year treasury yield in red from January 2016 to December of 2020. You can see that if you look at the federal funds rate, the Fed didn't start raising rates following the great financial crisis for the first time until December of 2016. And by December of 2018, they'd gotten the federal funds rate up to 2.5%. That's as high as it got. The 10-year treasury yield got up to about 3.25% in October of 2018 as the global economies of the world gained traction 13, 14, 15 following the great financial crisis. Then we started to have a global economic contraction in the fall of 2018 going into early 2019. That's why the treasury yields started to fall and they started to tumble precipitously. So that last little tumble in that highlighted area is when gold really started to catch a bid. Now, we hadn't had to worry about gold's inverse correlation to treasury yields for 6 or 8 years because for most of that time, the yield was very low. But this is exactly the same place we're in today. And that's why this is relevant, because yields are falling, but the Fed has not cut rates yet. So when I saw this happening, I said, this could unlock the gold price to go higher. And we put out an email to our database in June of 2019 when gold was 1330 that said turning point, gold could go higher. And sure enough, once the Fed actually started to cut, and they cut a quarter point and then another quarter point, gold jumped to 1520. It broke out of a 6-year ceiling it couldn't break over at 1375. Well, what happened next was COVID hit, and the Fed dropped rates all the way back down to zero, and gold jumped to 2070. This is where we are today. Right now, yields are falling. The 10-year treasury is coming off just like it did in the spring of 2019 before the Fed has actually cut the rates. Now we're right in the sweet spot of opportunity. The last 2 times this happened, in 2007 and again in 2019, gold jumped 10 to 15% in price once the Fed actually started cutting rates. We'll see if the third time's a charm in September, because that's where everyone's gaming that the Fed will actually start their rate cut cycle at a quarter point. And next Thursday or Friday, when the Fed meets in Jackson Hole, it's very likely that Jerome Powell will telegraph that they are going to cut rates, because the Fed doesn't do anything without preparing the markets first. And this is the perfect opportunity for Powell to say, hey, be ready for a rate cut in September. So this is what happened to gold. It broke out on falling treasury yields, and it actually got up to about 1560 on that run. COVID hit, and we got economic instability. We had a liquidation event. That's when stocks got hit, and that spike I showed you on the Dow chart. But gold ultimately started to climb higher, and then $6 trillion of new stimulus was printed out of thin air to supplement the economic closures. So we had a US debt explosion. In about a year, 3 different factors came into play that drove gold from under 1375 to 2070, where we got a top, let's call it a top at 2050 for the next couple of years. So as we move into 2020, now we're in the COVID environment with economic closures. Well, the $6 trillion of new debt did help to supplement the loss of economic activity. And we started to develop ways to combat COVID with vaccines. So gold entered into a trading range that was primarily between 1,700 when things were better and 2050 when things were worse. So just as we are moving into late 2020 into 2021, gold is settling primarily into about a 1,700 to 1,850 range. And then Russia invaded the Ukraine, and gold spiked from about 1,800 all the way back up to 2043, a second ceiling at around 2050. Now we've got yields are down, the dollar's weaker, we've got economic and geopolitical instability, and now inflation is starting to rear up. Let's take a look back at this chart again. Just to set this up, in early 2022, inflation was about 3%. By July of 2022, inflation was at 9%, where it peaked, 9.1%. And what happened? The gold price fell, which is very unusual. It was unexpected. But there's a reason for that. And it has to do with the dollar. This is a chart of the dollar index, which measures the dollar against a basket of other currencies. Going back to 2021, you can see going into 2022, the dollar had run up to about 95.5 on the dollar index, measured against the euro, the yen, the Swiss franc, and a couple of other currencies. But what happened to combat inflation? The Fed raised rates higher and faster than every other central bank around the world. And you can see how the dollar continued to gain value higher and higher against other currencies every time the Fed raised the rates, ultimately taking the dollar up to 114 on the index in October of 2022. And here's a clean chart that shows you that run higher. The dollar gained 18% against other currencies in about 10 months. This is a moonshot for a currency. Usually, if a currency moves 3, 4, 5% against other currencies in the course of a year, that's a lot. So this was a gigantic move higher for the dollar. And the reason it was so strong was because if you had your money in Europe, interest rates are lower. So you have geopolitical instability and you have a lower rate of return and you have real risk economically because of the war. So you bring your money to the US to put it into our markets, to put it into our treasury bills. But you have to buy the dollar first to get out of euros and into the dollar to get into our markets. And the same thing in Japan, which has had economic malaise for 20 years. So if you got money in Japan and your interest rate's 0.5%, and you can get 3 or 4% in the US, maybe 5% ultimately, you move your money from Japan into the US. That buoys the dollar. So that's why the dollar got so strong. And this dollar move higher coincides perfectly with the gold price being pressured lower. So strong dollar pressured gold all the way down to 1630. Well, what came after that was that other central banks started to raise their rates in response to inflation in Europe and Asia as well. So the interest rate differential, or the spread between the US and other countries, which was wide, narrowed. And that meant some of those euros and yen went back home again. They sold the dollar and moved some of that money back home. That caused the dollar to correct lower, and then it rebounded a bit. Well, the following move in gold is the exact opposite. Gold popped back up into the middle of the trading range and then softened. So this three-legged move down, up, and down for gold perfectly inversely correlates to the up move, the down move, and the up move in the dollar. You hardly ever see such a violent and direct correlation between dollar strength or weakness and the gold price. But this is a perfect example of it. And then just as we're settling back down again in the spring of 2023, well, we had a couple of bank failures. SVB Bank failed, Republic Bank failed, another one failed because they didn't manage their bond portfolio and the risk that they gained when interest rates rose and the collateral that they held in US bonds that were paying 1 or 2% dropped when the yield on the 10-year treasury got up to 5%. So that's the risk that the banks had. They failed, and gold responded due to economic uncertainty here in the US back up to 2050. So now we've got a triple top at 2050. So this is renewed economic instability on top of inflation and geopolitical instability. Then, just as gold is leaking again, things are getting a little bit better. Hamas attacks Israel. And now we've got a second geopolitical conflict in the world. And gold climbed from 1830, not to just 2050, but to 2100, where that little double top is right above the trend line. It's testing a breakout. And then it ultimately ran a lot hotter once the Iranian and the Israeli conflict grew. That first peak in gold over 2300 that's highlighted, coincides perfectly with Israel and Iran exchanging direct fire for the first time. So that's a hot run on a new war, more geopolitical instability. But again, a funny thing happened. Due to Russia's invasion of the Ukraine, the whole de-dollarization movement came up, where countries around the world are scared because we weaponize the dollar. Russia invades the Ukraine. We seize their assets, $600 billion worth of assets. We throw them off of the SWIFT international bank transfer system. And for the first time, we use the world's reserve currency power, which really having the world's reserve currency is all about power. But for years, we'd been benevolent with it. Well, now we're using it in a more aggressive manner. And countries around the world, particularly on the eastern side of the planet, said, hey, if the US can do that to Russia, they can do it to us. And that has brought up the whole BRICS movement, Brazil, Russia, India, China, South Africa, and a whole host of 17 to 25 other countries that want to become members of the BRICS nations. They're all worried about, hey, what happens if the US decides to do that to us and we're dependent on the dollar? Well, they want to get out of the dollar. And these countries are more than 50% of the world's population combined have economic clout. So the BRICS and the BRICS applicant countries have greater combined GDP than the US. They have about double the GDP of the European Union. So they potentially are significant as a bloc. But there's a problem with them wanting to get out of the dollar. They really can't, because it's embedded in the world's financial systems, and there is no viable currency to take the dollar's place in the settlement of transactions from country to country. But there's gold as an asset that cannot be seized in a vault. If you have gold in a vault, it can't be seized. And it's one of the world's most liquid assets. It's a tier 1 asset on the international banking system. So central banks have become record buyers of gold, creating a new demand wave since Russia invaded the Ukraine. This is a chart of central bank gold buying going back to 1950. For most of this period of time, until 2011, central banks have been net sellers of gold. And as you can see off to the right, since 2011, central banks have become net buyers of gold. Now, this carries us through into early 2022, and this is an updated chart that takes us all the way to 2023. For the first 11 years here, central bankers, before the Russian invasion of the Ukraine and the sanctioning by the US, Central bankers were buying about 500 tons of gold a year, which, if the mines produce 3,000 to 3,500 tons a year, is about 15, 16% of mine production. In the last 2 years, 22 and 23, they've bought 1,087 tons and 1,039 tons cumulatively, which is now about a third of annual mining production. And it's becoming material. So you've got a great surge of physical demand, and that's helping to buoy the price. Central bank gold buying doubles during those 2 years indicated on this chart. You can see the bottom in gold for most of 23 into 24 was higher than it was for that whole 2 years, 3 years previously. It was around 19 and a quarter until Hamas attacked Israel. So the base case is rising, and now we have a breakout higher on all of these factors coming into play at the same place at the same time. We've got record debt, now we've got 2 wars, and we've got record central bank demand. The one key that's really not in place, that's really in the lock now, that just hasn't quite turned yet, are falling yields in the US, which, when the Fed cuts rates, yields will fall farther. Now, if the US really goes into a hard recession and the Fed is forced to stimulate the economy with more quantitative easing, gold has explosive upside potential on a new surge of US debt. So all of these factors are now in the same place at the same time. And I've been doing this 44 years, and rarely have I ever seen all of these factors at play in one place at one time, which is why gold is hitting all-time highs. And we're right on the edge of what is potentially Fed cuts. So we'll just have to see how the economy does. It is kind of in a rollover phase right now, but we're getting some conflicting data. We got weak jobs a week ago. We got good retail sales today. So the US economy is still doing okay, but it's clearly weakening a bit. So those are the drivers that really push the gold price. And I think, if you'd ask me when gold was $1,375 in 2019, when are we going to see $3,000 gold? That's 5 years ago. I would have said, oh, that's a long ways off. And now it's 5 years later. If you ask me, when are we going to see $3,000 gold? I'm going to tell you it could be a year or two from now, just depending on how things go. So that's my presentation. This is how you contact me if you'd like. And I'm happy to do whatever you'd like to do next, Laura. That's the meat of my presentation.
Thank you so much, Dana. I think it provided quite a good insight. I have several questions, and I know everybody's asking, how can we use this? How can we use this on our tax strategy? And it's always a really, really great question. But I do have some questions for what you just mentioned, a couple of things. Because everybody's asking, and recently we had the conference in Nashville about cryptocurrency, and you said the gold is highly liquid. And there's a trend right now with the cryptocurrency and the leveraging, and they potentially could be higher liquidity on cryptocurrency because you have access to it 24/7. It's fast. You can just liquidate any assets in the crypto really, really fast. So do you see a shift from, because we see the central banks accumulating. I have here what banks and what countries are buying, and it looks like who's buying the most right now, who's upping their reserves of gold, is China and India, which, there's so many different things going on, and we don't want to get into the political aspect, but how do you see gold investment being affected by the cryptocurrency, rise? And again, we know that, right now the Republicans are really high on crypto. If that will take shape after the election, who knows if they get elected. And the Democrats, they don't have a whole lot to say on the cryptocurrency at this point. So so it could go either way. They say something is mostly political. We don't, bank our money on the political dilemmas. But how do you see this exchange of gold versus cryptocurrency? Could cryptocurrency replace all these hard assets that have been around for so many years? What's your take on that?
Well, gold's been around since ancient times. And for most of man's life on the planet, gold has been money used as currency. Now, it's still money, it has value, but it's not used as currency anymore. And they're two different things. Currency is a medium of exchange. So, cryptocurrency is a medium of exchange. Uh, when Bitcoin was making its run from under 10,000 to 65,000, 4 or 5 years ago, do think it impacted the gold price and held it in check by a couple of $100 an ounce because a lot of demand, especially from people 40 and under who are used to having cell phones and have grown up with these things. They like it because they can trade it on their phone, which you can't do with gold. And gold's a physical asset. When Bitcoin took a big correction lower, some of those people became interested in gold in the first time. So gold is actually much more stable than cryptocurrencies, especially Bitcoin. But there's no doubt about it that Bitcoin is here to stay, as are the other cryptocurrencies, especially with the adoption of Bitcoin by the big financial institutions in the United States. What Bitcoin actually allows you to do that gold doesn't do well is move real money, serious money across borders. That's really what Bitcoin and other cryptocurrencies are very good at, because gold, like paper money, there's currency controls on it. So you really can't move it across borders. But what we don't see, I don't see it, I could be wrong, is that central banks, they're not buying Bitcoin, they're buying gold, right?
I don't know if I'm sure about that right now.
Well,
I know they buy gold, but I don't know if they don't buy cryptocurrency. So
well, I could be
there's quite, yeah.
I could be corrected on that. So I'm ignorant on that fact.
Yeah.
I know they're buying gold at record amounts.
Yeah.
And there's a reason for that, because it is the world's most trusted
Yeah.
form of value. And it actually is becoming a world's reserve currency by default in other places right now, which is not happening in the US. So my concern with cryptocurrencies is, all the governments around the world are going to create their own digital currencies. We'll have a digital dollar. There's already a digital yuan in China. It's going to be working like a credit card. We already basically have that kind of a system via credit cards, where you have, instead of paper money trading hands, you've got plastic that you use to trade hands with. So, I'm an old school gold bug. We'll have to see what happens with crypto. So far, Bitcoin's been, pretty wild ride. It's kind of a speculation more than it is an investment. But that'll settle down as over time, as it becomes more and more and more established. In fact, we take Bitcoin in payment now that we were unable to do so in the past, because we couldn't settle it on a minute by minute basis with our transactions. We could only do it on a daily basis. If you're selling an ounce of gold and you're making 1 or 2% profit, and Bitcoin moves 3 or 4% in that same trading day, we could lose the currency value that we're trying to make in a small premium on an ounce of gold. So cryptocurrencies are here to stay. What kind of a challenge governments around the world give them, we'll have to see. And I know China's tried to lock down Bitcoin internally, which has been partially successful. So governments don't like the competition that Bitcoin is going to give them. So we'll see how it all plays out.
Yeah, yeah, thank you for that. So I want to bring just one item. I think this is probably the most common use of gold that I see in tax strategy for most people, and which comes with some challenges. And I want to see, what do you have for us? Gold is really, and precious metals, really, not just gold, is really has been used the most in retirement accounts, and it's used to really, hedge, inflation, really, what it is. So a lot of people have been investing in gold through self-directed IRAs, through solo 401k plans, especially my business owners who are really, we're trying to get a double benefit with gold, right? How can we invest right now? They don't want to invest in the stock market because the stock market is just very unstable, as you just mentioned, the economic uncertainty that we are facing right now. So if we are a business owner, right, we want to get a deduction. We fund our 401ks, cash balance plan, profit sharing plans with traditional funds, and then convert them either into a self-directed or Roth self-directed, in which we want to hold assets that can withstand all this, uncertainty, that we withstand all the inflation risks that we are facing right now. So, gold has been really, really good from that perspective. That's how people have been holding gold, right? It's a really good strategy for retirement accounts. I see some challenges with it. The challenge is, yes, we will take advantage as a tax strategy to first front load a deductible plan, then convert it to a plan that can hold gold. Okay. So that is the kicker, guys. Like, and I would be really curious to see, can you in the chat tell me who's a small business owner? Give me an X in the chat. Small business owners, my small business owners. Let's see if we can talk to the right crowd. Um, Wayne is a business owner. I want to make sure that we are speaking to you. If you're a small business owner or medium business owner, right, medium size, just mark an X for me. So right now it looks like Wayne, he could be the only one awake or the only one on coffee, or he's the only small business owner that we have. I'm sure we have more than Wayne. Anybody else business owner in the crowd? If you can let me know if you are a small business owner. Just an X. Yes, just give me an X.
Yeah, well,
Maybe it
I'm a
was not
small
the
business.
right. Probably I chose the wrong thing. We'll take it. Okay, so we have some more. Okay, so we have Jeff and we have Robin. Okay, so I'm sure we have very small. It does not matter. So everybody starts very small. The path to entrepreneurship is a long and heavy path. So everybody starts small. It doesn't matter who it is. So our small business owner. So the first thing we want to do, we want to kind of get the double benefit. If we know the end result, if I want to have gold, right? What's the most beneficial way to hold my gold? Do I want to hold it, in my house? Do I want to store it in my house? How do I want to hold gold, right? And most of the people, if you are using gold as a hedge against inflation and economic uncertainty, retirement accounts are really, really good for that. And again, my advice is to use a two-step approach. Instead of going directly to a self-directed, I would just take a traditional and then convert it to a self-directed so I can get the full benefit in all of this through your businesses. Again, we can have a whole conversation just on that, but that's really the first thing. So the challenge that a lot of the people had lately, or now it's not so much about because we know we don't get a return, right? We don't have cash flow. There's not a whole lot of cash flow. So which Neil was asking, can we get some cash flow from gold? So I'll let you answer that. But then the second piece to that question is, when gold is not doing so well, you have higher costs like insurance costs and storage fees. Can you walk us through, like, is there any way to mitigate those costs when we're holding this? Because everybody wants to see growth of their investments, right? They want to see that, hey, it's doing better. And when they see all these costs, right, without any cash flow generation, a lot of people get deflated and they're just like, oh, gold is not for me. So what would you tell to those small business owners who are really trying to leverage and counteract those fees?
Well, gold on average over the last 20 years has appreciated about 8% annually, which is right there with every other top investment. Now it's lumpy, as I showed you. It gets ahead of itself at times and it underperforms at times, depending upon what's driving it. So if you want to put gold away as a savings account or into an IRA, you should just put it away for the longer haul. It's money that you want to put aside that you don't want to touch for 5 to 10 years. And I think if you just let it ride, you'll be happy that you did, because it will hold its purchasing power over time, just like I've shown you it has over the last 23, 24 years. One of my friends who's a real estate investor and a precious metals proponent says, I give myself real estate and gold so I have a present for myself in 10 years. And I think that's a good way to look at it. So it's really, like I said, it's a savings account. Now, if you want to store it somewhere, you can store it at home. Home insurance policies tend to be a little bit higher if you're self-insuring through your traditional insurance company. You can store it at a storage facility. There are a couple of independent ones around the country where they'll take your gold and store it for you for about 0.5% of value that's stored there annually, which is not enough.
Okay, I think we lost Dana. You guys, can you see Dana? I think it's coming back up. Probably
There we
a
go.
power thing. Yeah.
Yeah. Great. So there's a couple of independent storage facilities. They're not banks, they're private storage
Mhm.
facilities around the country run by professionals. Uh, and you pay a 0.5% storage fee a year to store your metal there. And that's mostly for insurance. And I recommend if you do that, you get segregated storage, which means your metal lives alone by itself and it doesn't get commingled with other like items for quality reasons. But gold is not physical gold in particular. It's not for someone who wants to buy it now and sell it 3 months from now, 6 months, or a year or two from now. It's really for the
What's the
longer.
minimum? Dana, what's the minimum that you recommend? So you mentioned 5 years, 7 years, 10 years. So what's the, like, if we're looking at a graph, right, that you just mentioned, what is the minimum that you would say it's worth putting gold in? And just because the same concept happened with cryptocurrency. People were initially saying, I'm going to put it in, I'm not thinking about it. So you're not expecting to make a buck the next day. So what's the minimum that you recommend when you go into gold that you keep the investment?
Well, the World Gold Council has done a study that says 6 to 8% of net assets is appropriate, where you have enough of a hedge against financial uncertainty, as I've shown you in the chart, without losing opportunity in other areas as well. Right now, if it's in your IRA account and you're a younger person and you don't expect to touch it for years, you may want to go a little higher. But 5 to 10% is appropriate for most people.
Okay, so
I
let me clarify that. Let me clarify that. So you're saying the most appropriate kind of like share your entire portfolio, how you invest your from your net assets, is 6 to 8%. When you say net assets in this calculation, like what do you mean by net assets? I know some people are wondering.
total worth, like if you
Total.
your
So
balance sheet,
so
total
so your net
assets.
worth. So
Yeah,
so net worth, right? So for example, if we're taking a real example, your net worth would be all your assets, your house, your investment properties, all the investments that you have in various different investment opportunities, real estate, gold, IRAs, life cash value of your life insurance. All of them would be your assets. And then you take out all your liabilities, right? Your mortgages that you have whatever mortgage loans and notes they have, federal tax, bills that you have pending, and that's going to be your net worth, or in this case, your net asset. So, anybody has questions on that statistic or that recommendation? 6 to 8% of your net worth should be in gold,
yeah,
and
that's
that
what the
would be sufficient.
yeah, that's what the World Gold Council suggests, having done an exhaustive study over 20 years. And it's enough without, like I said, losing opportunity in other sectors.
Yeah, yeah, that's great. So, then what is the minimum time frame? Like, is there, for you mentioned that if you're younger, you can go in this gold. What if you're in your 50s, 60s, even later? Does it still make sense to invest in gold?
Yeah, but I wouldn't plan on investing monies that I would need for 5 years. I think you really need to be in it for a 5 year period in case we go into a market, say the economy gets a lot better, interest rates come
Okay.
down, and we go through a weaker period, you want to be able to ride that through that if the price comes down in dollars. So I think 5 years is a minimum time frame with a 10-year expectation is really probably the best way to look at,
Okay.
or longer.
Yeah, very good. So I have a couple of strategies that I think a lot of people are not taking into account when it comes to gold. And again, gold is really good when you have it held for some time. The earlier you have, for example, could you invest or can you buy gold for your kids? Can you put the kids, and then, how can you leverage that gold that let's say you paid the kids, let's say you're a small business owner, like Patty's a small business owner, or Robin, and they hire their kids in their business as a tax strategy. And with the money that you pay them, you buy gold. Just let's just think about it, right? So now we have gold. Now that gold can be used in several different ways for a tax strategy. You can gift it, right, to somebody else, or you can buy the gold and gift it to the kids. And it's a gifts have an amazing quality. You can gift every year, or what you can do is, let's say you're part of a nonprofit or you're very charitable, you can gift gold to a charity, like an appraised, that has a higher appraised value today than when you purchased it. So let's say you have gold that you inherited, right? With the 10,000 value, right? And now it's at $100,000 value, let's say, that inheritance, you actually get a write-off for that, $100,000 that you donate. So there's a lot of ways you can use gold in gifting. When you have gold in your estate, what happens with gold, it's really, really important that we invest in gold really early. Why? Because we want it to appreciate. We want to have that, we have time on our side. Because in
Exactly.
20 years, in 30 years, you pass, and your successors, your kids, whoever inherits the gold, they actually get face value, right? So if you bought it for, like, say, $1,000 today, it will be whatever value is when they receive it, face value, and it's not taxable. Really, really great to diversify in your estate planning. The other piece that I want to touch is, really 1031 exchange, which was a really high, on the gold market and every other like type of property. So in 2018, when the DCGA Act was passed, they limited that to real property only. And there have been quite a few conversations about 1031 exchanges to bring gold back. And it was not just gold, it was any type of other properties outside the real estate. What is your experience with the 1031 exchange? Do you think they're going to let us exchange gold again? I know there's some heat on the 1031 exchange rules. What have you seen historically? Because that would be a really, really great tax deferred exchange. The gold will really, I think it would skyrocket the gold in that scenario if that would be allowed as of right now.
Oh, I would love to see that happen. Whether I don't know. I have no idea whether what the chances of that happening. One of the strategies a friend of mine who's in real estate told me about in 2018, and I actually deployed it in 2020, was to take a mortgage out of my property and buy gold with it and just sit on it for 10 years. Now I'm a gold dealer and I didn't even think about this, but I did take a mortgage when rates were 3.25%, and that money I used to buy gold with. And now I've got an appreciation on my property. I have to service the debt. It's not a rental property. So I'm paying the mortgage myself, but my gold is up 25% as well. Now, if I could 1031 that into more rental properties, I'd love to be able to do that, but I can't.
Well, it's not
Right.
like so even if 1031 exchange brings gold back on the line, it's not just qualified property to exchange. And anybody who's interested, like 1031 exchange allows you to exchange like kind property. For example, any type like real estate, you exchange a like kind property to another real estate property, and you defer any type of capital gains on it. So there's no taxation on it. You defer the entire gain, right? That's why 1031 exchange is really, really, really loved by the investors. So that's one of the way to swap investment property for gold, which I think that would be really, really great hit. They were looking at 1031 exchange last year, so now they have a huge proposal tax bill. I don't know if it's worth looking at it because we don't know who's going to get elected, and there's a huge gap between one party and the other. So let me ask you, because what you mentioned is really good. We see, stocks and all kinds of brokerage accounts being used to back loans. So leveraging gold backed loans is a real deal.
Right.
Have you seen, like, tell me, how can you, and what do you see in that aspect? Have you seen anything in that aspect?
Well, yeah, there's a couple of places where you can actually use gold as collateral to get a loan. So there's a
Mhm.
storage facility in Las Vegas is where one of these storage facilities that I like is. It's independently run. It's called Trans Depository Services. If you store your gold there and want to then borrow against it, they have a financing arm called Collateral Finance Corporation where
Mhm.
you just sign the papers. They take control of your physical gold and they loan you the money against it. Now you're going to pay prime plus a couple points. It won't be a competitive interest rate, but it's actually a way for you to collateralize your gold and take that money that's there and use it for other purposes.
Mhm.
There's another bank that will come online in the next sometime this year. I'm hoping it's called Battle Bank that will specialize in loaning against hard assets like precious metals or vintage coins. It's run by a gentleman by the name of Rick Rule, who is one of the most respected natural resource mining stock investors and analysts in the world. So he's creating his own bank to specialize in niche loaning like this. And he'll have rates that are more competitive than Collateral Finance Corporation, but you can borrow against precious metals, about 75% loan to value ratio. If the value drops, you could get up what's called a margin call. So you have to be aware that that's, a possibility. But you can borrow against precious metals that way.
Yeah, so the application for a business owner then would be a business owner can leverage their gold holdings. Let's say you have gold to, have that position of a power in your business, and you can leverage your gold holdings to take out loans for your business, for expansion, for other purposes for your business. And then the interest on the loan, again, is tax deductible. And you can use the loan proceeds for business investments that can, you get more tax deductions with. So you always want to think outside the box and think, how can I use this any type of holding that you have an investment, how can you leverage it and use it to become or to create more tax deductions? So we talked about gold in business succession planning. So again, incorporating gold as part of your business, kind of like estate planning or succession planning for you as a family, as an individual, is really, really a great way, because if properly structured, you can minimize estate taxes. And estate taxes, I know we don't like to think about it, but on the call right now, they want to drop the limit on the estate for the estate taxes. And if that drops to 5 million, and again, we don't say it's a lot, but people in California, they own a home and a couple of rentals, and here you go, you're at 5 million. So it can hit a lot of people. I think a lot of people get hit with that. So don't die when a new law gets passed. Just put yourself on oxygen. I don't know, just something, just something to delay that. So that would be I think the transition of wealth is much smoother from that point of view if you incorporate some of this, gold in it. And again, we talked about gifting gold and gifting gold. So I want to talk about gifts, because gifts are really the way I use gifts from a tax perspective. It has a couple of implications, right? So there are three ways to, or not, they're all gifting really in essence, but for tax purposes, we mentioned, but I just want to recap on this. We have gifting to another person, right? Giving to your brother, your mother, your daughter, your son, whoever, your friend, anybody. So gifting from one person to another, which has the limits how much you can gift. So let's say you want to help, you want to do something. Gifting is this really, really good for us to be able to use gold if that's really the case. So in gifting, we're limited to the yearly cap that what we can give. And then we have gifting, which comes as an inheritance. Inheritance is tax-free, right? And what happens with inheritance, again, gets the face value at the date of death, which is really, really good. So having gold in your assets, in the portfolio that you put together, it's really, really great. And then you have gifting, which is using as gift, but it's really gifting to charitable organizations where you get a full write-off for the face value of the asset the day you give it, right? Typically would get appraised, we get all of this. And a lot of people are using this, charitable strategies as a tax strategy. Again, it doesn't mean that you're not giving out of the goodness of your heart, but tax strategies with the charitable combined create great, great ways to reduce your tax bill. And I know it takes a while to get used to that idea, but it's really great. So the other thing that I want to mention, because we're coming at the top of the hour, is deduction. Any type of deduction strategies for gold mining investments. And if you can give us any type of gold mining companies, because investing a gold mining company or a partnership really offering tax deductions for the mining operations, because mining does use equipment, and hence we have write-offs, and it's an active business. What do you have anything for us on the gold mining companies?
I hate to disappoint you, Laura, but I am a humble physical metals dealer. I'm not a mining stock expert nor a mining stock tax expert. So I would refer you to my colleague, Brian London. He writes the Gold newsletter. He's in New Orleans, Louisiana. I worked with Brian in the 80s for 10 years when we both worked for Jim Blanchard. He is a mining stock expert. I don't think that he's a tax expert, but if you want to know more about mining companies, Brian is the one for that. Rick Rule, again with Rule Investment Media, is a mining stock expert extraordinaire. So he may be able to shed some light on that for you as well, but I'm not the person to go to for that question.
Yeah. So again, I'll bring the kind of the insight for gold mining investments because it's really, if we find, again, I'm telling you what the tax law allows us to do and what kind of strategy we can use. The same way when Bitcoin got started, it started with like mining Bitcoin, right? So again, going investing in mining for gold mining operations really gives you access to depletion, right? Depletion of the natural asset, which is gold, and depreciation of all the equipment they use in mining. So if you want to hold gold, and you don't want to just buy the gold outright, you can invest in companies that are just, their goal is just gold mining, right? So that would be a great strategy for you to really look into it. I wish I would have more gold mining companies to refer you to, but again, we could probably put something together from what Dana mentioned to look into what gold mining companies, and to really get the benefits. I want you to always remember any benefits that you want to get on tax strategies, they have to be on US soil. So for example, if I invest in a gold mining company in South Africa, it's not going to be the same. Like we have to do all these investments on US soil to really take advantage on a tax perspective. Yeah, go ahead.
Yeah, so let me just
Yeah,
say a thing about that.
yeah,
Most of the gold mining around the world is not
yeah,
done in
in
the
here.
United States. And the reason is because gold mining is a very dirty, ecologically unfriendly business. So there are a few gold mines here in the US, but you'll find most of the gold's annual production comes outside of the US. The biggest mining company is Newmont Mining. If you want to, one of the marquee mineral resource companies, Newmont Mining is one of them, or Barrick Mining Metals.
Yeah, yeah, very good. So, you guys, if you want to take note of that. So, there are a couple of other things that I want to mention. Like again, gold, when you sell it, it would be capital gains treatment. So, I want to make sure that you keep that in mind. And a lot of people are talking about gold and AMT. And again, when you have a lot of capital gains, like you always have to strategically look at what kind of investments you are holding to leverage to see, okay, are we going to have AMT, and mitigate any AMT exposure with selling our gold. But gold, again, depending on how you got the gold, did you buy it? Did you inherit the gold? Was it gifted to you? Like it's really important to create a strategy around gold. Gold is not something that you just want to do on an instinct, like, oh, I just want to go in and do X, Y, and Z. You have to have a long-term strategy of how to acquire gold, how you pass it on to the next generation's gold, and what do you want to use the gold for? How are you going to leverage? So gold is really, I think, it's not probably your top hottest thing on tax strategy, like real estate is, or like crypto gives a lot because it has such high fluctuation. We can use the harvest lost on a cryptocurrency. Gold is not so highly volatile as cryptocurrency is right now. Although it could be, depending on the graph that you're looking at and the spam you're looking at. So I want you to be really kind of taking gold as part of the bigger strategy and thinking, how can I create a long-term plan that brings gold into my portfolio to leverage, and how do I want to use it? And I hope that answered your question. So there was an anonymous question. Gold is a good investment and safer. I don't see how it saves me taxes. So you have to have a long-term plan to get it into your tax strategy. So I hope that answers your question. Any other questions? I know we're top of the hour. Any other questions for Dana or myself when it comes to gold or tax? If you want to drop them in the chat for me, that would be great. Dana, I want to say thank you so much for the great insights that you brought. And I think there's a lot. I have so many more questions for you about this new election, how gold is going to fare with the election, if more war, there's a lot of war on the Middle East right now. If anything like that is happening, would we see a rise? Like, there's just so many questions because the uncertainties are so great right now. If you want to just touch base on that for a minute, that would be great.
Well, I think one thing we can count on, no matter which party wins, is that our debt's just going to continue to go higher. And that's really one of the main drivers of gold. Um, We have two wars going on right now, and neither one looks like it's going to be over anytime soon. I know that Iran and Israel don't really want to get into a full-fledged direct conflict. We've seen instances of where they could have and they backed down a couple times now. We're still waiting for the Iranian response to the Israeli assassination of one of the Hezbollah leaders when he was in Iran for the president's funeral. But we have conflict, and we also have, more importantly, a divided world where it's becoming China and Russia and the BRICS nations wanting to more and more decouple from Western transactions and the dollar in particular. So they're buying gold at record rates. All these things point to gold going higher and perhaps substantially over time. That's why it's a good long-term hold. And I don't see any of these big trends changing anytime soon. And that's the point I think most people should realize right now. This is the environment we're in, and we're going to be here for a while longer.
Yeah, absolutely. So I want to say thank you. I want to respect your time, everyone. Thank you, Dana, for sharing your insight with us. And thank you all for attending and being here with us, and just kind of seeing, just taking a look at, on a graph, how is it going to, what's the goal trajectory? And there's just so many different things happening in the world right now. And we see, like, there was a post the other day about the only industries that are doing really well right now is military and gold, which that tells you kind of the state of the economy. And it's not just a U.S. economy, it's a world economy. I really want to have that conversation that gold is something that we have to think about in our portfolio. So I want to say thank you again. Neil had another question. There are a number of direct stock and ETFs that track gold. Can you tell how taxes on this may be different? It all depends who and where do you hold the stock, right? So that is really important. Where are you holding the stock? Is it you personally holding the stock? Is it your business? Is it in a retirement account? That's really the most important. Direct personal, yeah. So it's really the biggest piece right now is like, okay, how are we going to use it, right? Because we have the capital gains tax. How do you track gold? How taxes on this may be different. There's not a whole lot of difference on the tax arena on that, because you still have the same 15-20% tax on it on a long term. If its term is going to be, it's going to be ordinary income as a tax. So any other, before we let everybody go, any questions for tax and gold? Again, I would really encourage you, if you hold any type of assets personally, what I would really recommend is really for you to explore a Roth IRAs, because you want to be able, unless you have a direct, directive in your estate to gift the gold, right? And you're not intending to live off of the gold sales that you will have to do or sell in your retirement. I really want to encourage you to think about Roth IRAs. Self-directed Roth IRAs are really a great tool, because now if I need to live off of the money, I can leverage that growth and to be tax-free for me long term. If your intent for the gold is to gift it and to just pass it on to the next generations, holding it personally makes the most sense. Okay, so I hope that answers your question about gold and how you can differentiate when it makes sense to put into retirement. Retirement is meant to give you cash flow when you're retired. Okay, retirement is not meant for you to take it and just pass it on to your kids. Very, very clear on that. It's just that's really not the purpose for retirement. It's cash flow. We want to put the things that want to cash flow. All the other ones we want to hold personally, because we can just gift them out of our estate. So I hope that makes sense from a tax perspective. Then again, say thank you so much for being with us today. Thank you all for coming. I wish you a really great end of the week, and we'll see you again in tax Q&As here with great guests like Dana. Dana, thank you. Thank you, everybody. Thank you so much. Have a great week. Okay, we'll get some music. I don't like to hang up on people, so I decided I will just get some music. Let's see if we can get the music up. And this track is called Pineapples. Can you guys hear the music? Thank you so much. Have a great week, everyone.
Thank you,
We'll
Laura.
send the recording. Yes, we'll send the recording We'll send the recording out via email. Thank you for coming, and we'll see you again in the next Q&A, which is going to be next month. Thanks for the great questions, Neil. Yeah, bye, Margaret. Bye, Ken. Bye, Jeff. Bye, Carolyn. Have a great week, guys. Bye, Robin. You guys enjoy your week. Any tax questions as you go through your week, jot them down. I would love to answer your text in our next Q&A. Thank you so much, everybody.